What's going on, guys? Welcome back to another video, and in this video I'm going to share with you the strategy that completely flipped my trading game on its head, the ICT 2022 Mentorship Model. The reason why I say this changed my game forever is because it introduced a ton of key concepts that I didn't know prior to this, which basically ended up acting as the catalyst for the rest of my learning and development as a trader. But the majority of the concepts from this trading model are at the foundation of all of the strategies that I use every day. Before I start though, I really have to give props to my guy, Cammy Capital, for leading me on the right path. I came across his channel randomly early on, and his explanation of the 2022 mentorship model was the jumpstart to my trading game. Up until this point, I literally only traded fair value gaps without any context. I saw them work a few times out of luck, but ended up losing more than I won because I really had no idea what I was doing. So big shout out to Cammy. And if you haven't already, make sure you go and check out his channel. I'll have it linked below in the description. He's a great trader, recognized by the man ICT himself in one of his live streams, I think, and he's just an overall cool dude. And also make sure to actually go back and watch ICT's 2022 mentorship playlist so that you can get the full picture. There's really nothing better than the source, and there are a ton of details in that playlist that you should at least be familiar with. So let's dive into the 2022 mentorship model. I'll go over how I interpret the model and how I trade it. So there are a few things you need to see before even considering the 2022 mentorship model. First, you gotta have a daily bias and a draw on liquidity. So essentially, where is price most likely trying to head to next? What trend have we been in? These are things that we need to make sure to solidify before we even begin to look for an entry in a trade. So our higher time frame bias has to always line up with our lower time frame models in order to significantly increase our chances of success. Next, you'll need to identify and mark out high liquidity levels. So I like to focus personally on significant higher time frame highs and lows, typically at least on the hourly and above. So these include overnight session highs and lows, current session highs and lows, previous day highs and previous day lows. And you can also consider the New York lunch highs and lows. But in general, higher time frame swing points are points of interest. Number 3, you need to make sure you're aligned with time. And I think this is a very important concept that a lot of traders disregard because it isn't a super flashy concept, but trading within what are called kill zones will significantly increase your chances of finding high probability setups. You don't necessarily always have to trade within the kill zones, but like I just said, it increases your chances of finding a good setup and the chances of it actually working out in your favor. So if you're a New York AM trader, look to trade the AM kill zones from 8:30 to 11 AM Eastern. If you're a London open trader, look for trades within the 2 AM to 5 AM New York Eastern, etc. And again, reason for this is that you'll just see much more volatility within these kill zones due to the amount of volume being traded in these hours. So those are 3 very important first steps within this model that I think if you don't have, then it's going to be pretty difficult to trade this strategy. So make sure that you can figure out those 3 before even continuing. So to begin looking for the 2022 mentorship model, you need to see price come to one of the levels that you've identified in step 2. And you need to see a sweep. So just to draw out some structure here, let's say we're in a bullish trend here. Just like that. You see price come up to take out one of those levels that you actually saw or that you marked out in step 2, right? So we sweep and then you get this structure, right? So if you see a displacement through the liquidity level right here, rather than a wick and a close below or above the liquidity level, you're most likely on the wrong side of daily bias, and you should probably proceed with caution. So I'll go over what displacement is in a bit, but what we'd like to see ideally is a wick through this liquidity, this higher time frame point of interest. We want to see a wick and not a close above in this case. So this is the sweep that we want to be seeing. Next, step 5 is market structure shift. So what a market structure shift is that when price, in this case, we're looking for a bearish entry, right? If price has been creating bullish structure with these higher highs, higher lows, sweeps this high on the higher time frame point of interest, and then ends up trading down to take out the near swing low, which is right here. That is considered a market structure shift. So you don't necessarily have to close below it. And this is according to ICT himself in his 2022 mentorship playlist. You don't necessarily have to close below that market structure, or below that swing low, but you need to at least break it with a wick. So it needs to trade down below and break that low. So when we see this, price has essentially gone from bullish price movement to bearish by breaking structure and initiating the downtrend. So that is a market structure shift. Next, step 6 is displacement. So displacement is incredibly important. And typically when you don't see displacement, I think the trade probability drops pretty drastically. Displacement is a very, very significant indication that you're on the right side of the trade. So I mentioned it before, but displacement is essentially an energetic move in a direction that leaves imbalances known as fair value gaps. So like I said, this is normally a pretty strong confirmation that the move has started and that the 2022 mentorship model is in play. So displacement, that is key. So step 7, once the displacement has occurred, you'll need to find an entry. So displacement leaves fair value gaps. That's what we're looking for. So once the displacement has occurred, you'll need to find an entry. So I like to use the 5-minute or the 1-minute, really depends. I like to use the 5-minute to confirm structure, meaning the break of structure here, but it's really what you see when you back test. It's what you're comfortable with. So go with your gut, go with what you've seen, and go with what you're more comfortable with. So when it comes to these fair value gaps and setting your entries, there's a lot more to it than just kind of blindly setting an entry somewhere. There are things that come into play like premium and discount, the gap that actually broke structure, your risk tolerance. There's a lot of stuff that comes into play when you search for an entry on a displacing gap. For now, and what I would suggest if you're new to this, use the fair value gap that basically created the market structure shift. In my experience, I've seen those work out, especially if this displacing leg is very strong. You'll see that price will most likely want to tap into the nearest fair value gap before continuing down on its strong downtrend. So that's my suggestion. Go and back test it, see what other scenarios have provided, and go with what you would be most comfortable with, because you're gonna have to set your entry here, and it really depends on your risk tolerance as well. So you could set it at the end of this fair value gap, or you could place it above the first fair value gap in this case, just in case price does want to come back and tap into that. You'll still be in the trade and you'll still be on the right side. So like I said, go in and figure out what you're comfortable with, what you see in your back tests, and then go forward test it in the live markets. So the reason why we set entries at a fair value gap instead of trying to market order and chase price is because when price displaces violently, like we see here, and leaves a gap of inefficiency, it'll most likely want to come back to rebalance it before continuing in its trend. So price moves typically for 3 reasons, and it's to hunt liquidity, rebalance inefficiencies, or rebalance to equilibrium. And we see 2 of those clearly in the 2022 mentorship model. we see price hunt liquidity right here at this higher time frame point of interest, this buy side liquidity right here. And then we see price trade back after market structure shift. We see price trade back into the fair value gaps, literal gaps of inefficiencies left by the market. We see price trade back into it to rebalance it and then continue back down on its downtrend. So that's why we don't necessarily want to market order and chase, because if you chase, you're most likely going to get a worse entry. You're going to have to sit and draw down. You might even get stopped out depending on what your risk tolerance is. So the game is patience. That's the key operative word. You want to stay patient. You want to see price come back to tap you in. Sometimes it does, sometimes it doesn't, but you know, that's a part of the game as well. If you miss a trade, that's fine. There will be other trades that you can find and enter and price will respect. Sometimes the market's just moving too fast. You had the right idea and you just didn't get tapped in. It happens to everyone. You just got to live with it. You got to stay patient and disciplined, and then you'll eventually catch a really, really good trade. You just got to keep looking and abide by your rules. So that's why we don't just market order and chase price. So now at this point, you're in the trade, you got tagged in. Now you just got to manage your trade. You should already have most of these figured out before you enter, meaning your risk and your profit targets. But once you're tagged in, you should just be managing. You can adjust your targets. You could go for 2R, which would be down here. You could go for the next liquidity pool if there's another swing low down here that you want to be targeting. It's all going to depend on what you see in the market, what it's been doing, and what you're comfortable with. So that's pretty much it for the checklist. Let's go ahead and take a look at some examples. All right, so here's our first example. I'm going to be going through the checklist, basically going through reading price, and checking off what we need to see within the mentorship model to actually enter a trade and successfully hit a profit target. So right here, just looking on the daily, and I like to start on the daily, we have this daily fair value gap. We also saw that price took out this external range liquidity. So price likes to move from external to internal range liquidity. So because we tapped and we traded past that external range liquidity with this daily fair value gap created, I'm expecting price to come back into this daily fair value gap and rebalance and continue up. So I'm still a little bullish. I like to see some bullish movement, and I like to see some bullish entries. So going down to the hourly, move over to the next day, we see this right at market open. Now from what I'm seeing a lot of relative equal lows here. So my eyes are automatically down here because I am bullish. I want to see some manipulation to the downside to take out sell side liquidity before moving back up to take out external range again. Got buy side right here. That would be my plan going into this day. So that's my higher time frame point of interest. That's step 2. Now I want to drop down to the 5-minute and just kind of watch what price does. So this is around market open right here. Trade down. We have this 5-minute fair value gap, this SIBI right here. So we'll see what happens when price trades into that inefficiency right here. We trade through it, respecting it. Now we're up. No real trade for me. I don't see any sell side taken yet. and then we finally go and sweep all of that sell side liquidity right here. So this was the lunch hour. I don't trade the lunch hour. I suggest you not to either. From my experience, there's a lot of slow price action, lower probability. I think I took a trade once back in the day, and it took me about like an hour and a half of just draw down and chop to actually get to my target. So in my opinion, not worth it. There are plenty of other trades throughout the day that you can take that are higher volatility and, you know, higher chance of success. So that's just my suggestion. But yeah, going back to this, we see the sweep of sell side liquidity. Even on the 5-minute, we trade through and then close above. So for me, if I'm bullish, that looks pretty good. So I can jump to the 1-minute for another more precise entry. And what do we see here? We see the sweep of liquidity of the higher time frame POI, close back above it. We have market structure shift there. A displacing candle, leaving a fair value gap right there on the 1-minute. So that pretty much checks off most of our, or pretty much all of our checklist. We just need to set an entry right at that fair value gap. We can set our stop here. This, I think, is a little too little of risk. I think you're not going to have a lot of room to work with. This is pretty good. This is doable as well. I don't think it'll come down here unless our bias is completely wrong. But you never know. The market does whatever it wants to. So 2-hour trade at least, or target opposing liquidity. And now let's see what happens. Price moving. We get tapped in right there. Respects that 1-minute fair value gap very well. And then we proceed to take out our target. So we established our daily bias and our draw on liquidity, right? It was to go bullish because of bullish for value gaps on the daily. We wanted to see some sort of sell side taken, some manipulation before moving back up towards our draw on liquidity. We saw the market structure shift, and then we saw displacement through that swing high, leaving a fair value gap. Set our entry at the top of that fair value gap with manageable risk, whatever fits your risk tolerance and your risk profile, and then try to aim for at least 2R. For me, that's my goal, at least 2R, and then opposing liquidity if you are comfortable doing that. So that's example 1. Let's go to another example. All right, here is example 2. So we're back on the daily chart right here. And first thing that I see is this massive daily bullish fair value gap. So next I want to, so I'm thinking bullish here, right? We tapped into consequent encroachment of this fair value gap. We had a very strong candle, daily candle the day before. So my draw on liquidity is at least this swing high right here, this external range liquidity right here, and possibly this up here. But one step at a time. I'm looking for the first, and then potentially we can see if it hits the second. But that's my bias and my draw on liquidity. So that's step 1. All right, so dropping down to the hourly chart now, we can see we also have this hourly bullish for value gap. We see pre-market that we trade down into this hourly for value gap. We have a close below consequent encroachment, so I'm kind of 50-50 on what to do here and what to think, but I am still bullish because on a higher time frame, we're reacting off of the daily bullish for value gap, and we had a very strong close the day before. So I'm still bullish, but I'm letting the market play out and do its thing, and I'm going to adapt and react to whatever I see and what the market gives me. So that's my approach to every trading day. I don't go in married to a bias. I am willing to switch things up and react accordingly. So we see price at pre-market drop down into this hourly fair value gap, trying to rebalance this. So I'm still bullish, like I said. So let's drop down to the 5-minute and see what happens here. So we traded down past consequent encroachment. Now I'd like to see some bullish action here if I want to keep my bullish bias. We get another sweep of liquidity here of equal lows. See that very well, but look at that. We end up sweeping liquidity and closing above that level, right? So this was basically that 1 hour higher time frame from pre-market. This was that sell side liquidity that was created on the hourly. So it's still a higher time frame, point of interest. Once the market opens, we end up sweeping that level and reacting pretty favorably to the upside. So what am I seeing here? I'm seeing this swing high get taken out, and I'm also seeing this swing high. So you can consider both of those market structure shifts. I would honestly consider this swing high being the more significant market structure shift, just because it's a much more defined swing high. But to confirm, I think having both of these are a strong confirmation that we're on the right side of the market. So next, you see displacement on this fair value gap here. You also have this fair value gap. So this trade is looking pretty good. So what do you want to do next? You want to set your entry on the displacing leg, the fair value gap that actually breaks market structure. So here, 31 points of risk is pretty solid. It's well within my risk tolerance. You could put it down here if it fits your risk profile. That's a little too much for me. But this would honestly give you room just in case price does want to come in and tap this fair value gap. But like I said, this displacing leg looks pretty strong. So I don't think that price is going to come back all the way down here. It could. I could be wrong, but you're just going to have to go and back test and figure out what you're comfortable with when using this model. So I'm going to set my entry here, my risks, my stops down here, and then aim for at least 2R or this opposing liquidity pool right here. So we get tapped in. Pretty close to getting stopped out. So I would have been stressing a little bit there, but if I set my trade and I set my stops and my target, I am respecting it. That's what a lot of traders, I feel like, when they're beginning, have struggles with. Whatever you put down in the market and what you enter in, you need to be willing to let it work out. So that's why it's important to have your risk and your stops ready to go even before you enter a trade. You need to be willing to lose it in order to win it. So I'm not touching my stop here. If it stops me out, that's fine. I was ready to lose it, but I'm also ready to win and make and hit this profit. And that's what happens. So going over what just happened, we had our daily bias, which was bullish because we were trading within a daily bullish fair value gap. Drawn liquidity was higher at external range liquidity at the swing highs on the daily candle, or the daily chart, sorry. We set our higher time frame points of interest. So on the hourly, we had this 1 hour bullish fair value gap. We saw pre-market that we traded down past consequent encroachment, set that low and relative equal lows. We were well within time, so pre-market happened, and the down move happened at pre-market. Market opened, we're within the New York AM kill zone. We swept liquidity, close above, market structure shift with displacement, leaving multiple fair value gaps. We set our entry at the fair value gap that took out market structure, set our risk, set our target, and then let the trade work out. So 2R for me here. This is a great trade. 68 points is nothing small. It's a pretty big deal, especially when you're starting out. So take your winners. You could have aimed for, the full range. And I think, if you had the right reasoning, you had the right logic, it's very doable. You're just gonna have to sit in the trade a little bit longer, but it works out, right? Like in hindsight, it works out. It's a 160 point move. It's massive. But so is 68 points. So take what you can get, take your piece from the market. Don't get overly greedy. Sometimes it works out and you have a great day, and sometimes it'll come back down to stop you out at break even, or even worse, stop you out for a loss. So you never know what's going to happen. You just got to take what you can get and live with it. But that's pretty much it for the 2022 mentorship model, you guys. In my opinion, the concepts that are laid out in this model are foundational to everything else that I've seen or studied. So that encompasses establishing a daily bias, identifying high liquidity points of interest, liquidity sweeps, market structure shifts, displacements, imbalances. All of these things are instrumental in pretty much everything that ICT teaches, which is why it's foundational to the way that I also trade. So I hope this was helpful in some way. I think this model is a great place to start for anyone that's looking to get into trading ICT concepts. And it's been proven successful by many traders out there. So if you go and backtest, you'll see this model appear multiple times a week. It can be a pretty useful strategy to have at your disposal, in my opinion. So if you have any questions, go ahead and leave me a comment below, and I'll try to help out however I can. If you enjoyed this video, make sure to like the video and subscribe to the channel for more content. Good luck trading, and I will see you guys next time.